Hello, good day. Welcome to today's lecture in a practical introduction to day trading. So in this lecture, we will look at technical analysis. More specifically, we will look at trends and indicators. So we covered a lot of material in the past 4 videos. We looked at different types of assets. We looked at stocks, we looked at bonds, we looked at Forex, we looked at commodities, we looked at cryptocurrencies. Recall, a stock represents a share of ownership of a company. A bond is a debt instrument that was issued by a government. A bond has 2 components. It has a par value and it has a coupon. The par value is the principal or what you paid to receive the debt instrument. The coupon is the interest that will be paid by the bond. The maturity date is the date where the bond may expire and you will receive the par value of the bond as well as whatever coupon or interest that is outstanding. Forex refers to foreign exchange. They are currency pairs. Example, the Euro USD. Commodities are primary commodities which are traded on financial markets. There are agricultural commodities, energy commodities, and metals. The metals have a subcategory called bullion. Bullion includes gold and silver. Cryptocurrencies are another type of asset. This includes assets such as Bitcoin, Dogecoin, and Ethereum. We also discussed trading, speculating, and investing. Trading is a subset of speculating. Speculating is when an economic agent is not interested in an actual asset. However, they realize that the asset price changes over a period of time. Therefore, they decide to buy and sell the asset with the objective of making a profit from changes in the price of the asset. Trading is a practice where an economic agent buys and sells the asset over a short period of time with an objective of making a profit from the price fluctuations. Investing is a practice where an economic agent buys and sells an asset with the objective of earning a profit from the interest paid by the asset. Investors hold assets over long periods of time, usually spanning more than a year, and they earn a profit from the interest paid by the asset. In contrast, traders buy and sell assets over a short period of time, and they make a profit from changes in the price of the asset. Traders are speculators. We explored how to install the software on your computer. We explored how to select a broker. We looked at 3 different types of market analysis. They are technical analysis, fundamental analysis, and top-down analysis. And in the previous video, we looked at resistance and support. Recall, resistance is analogous to a price ceiling that suggests an area where the price of the asset may experience difficulty in going above. Likewise, support may be analogous to a price floor. This suggests an area where the price of the asset may experience difficulty in going below. In this lecture, we want to go in greater detail into technical analysis. More specifically, we want to explore trend lines. So trend lines are lines that are used to draw trends. Trend lines can be used to highlight or determine the overall direction of the price of an asset. To draw trend lines properly, all you have to do is locate 2 major tops or 2 major bottoms and then connect them. As we saw previously with support and resistance, 2 touches suggest an area may be support, or 2 touches suggest an area may be resistance. The 3rd touch confirms an actual area could be support or resistance. The same concept applies to trend lines. 2 touches suggest a trend, The third touch confirms a trend. We see here an uptrend. An uptrend suggests the price of the asset is going up. A downtrend suggests the price of the asset is going down. We see a downtrend. This is a sideways pattern. This suggests the price of the asset is going sideways. The price of the asset is going horizontal. This is an uptrend. This is a downtrend. How we determine uptrends, downtrends, and sideways trends is by looking at the highs and the lows. Higher highs and higher lows suggest an uptrend. Lower highs and lower lows suggest a downtrend. When the highs are neither becoming higher or lower, it suggests a sideways trend. Likewise, when the lows are neither getting lower or higher, it suggests that the trend may be proceeding sideways. Let's look at a random currency pair. This currency pair is the NZD USD, the New Zealand dollar, US dollar. We can see a trend right here. This is a downtrend. How can we determine this is a downtrend? We see lower highs. One high here, a lower high here. We use a trend line to connect the lower highs. This area was a potential area of support that is now acting as resistance. It acts at resistance, it acts as resistance. After the downtrend here, what is the asset doing? Well, we draw a trend line. So I drew this trend line by connecting this low with this low. This was somewhat of an uptrend. Then we see the price of the asset break the uptrend. This suggests the asset may be going in a downtrend. I connect the lower lows. I connect the lower lows, one low, another low, a third low, 3 touches, confirm a downtrend. This suggests a downtrend. The price of the asset broke the downtrend. So it seems that the downtrend became steeper. We can also draw the downtrend by connecting the lower highs. After the price of the asset broke the downtrend, there seems to be an uptrend. And then the price of the asset seems to be going sideways. How I realized the price of the asset was going sideways? We see a series of lows, 1, 2, 3, 3 lows. This actually confirms an area of support. This support went sideways. We see 3 highs, 1, 2, 3, 4. We see 4 highs. The price of the asset appears to be going sideways. We confirm this with a trend line. So the price of the asset went up. The price of the asset went down. There was a change in the gradient. The price of the asset went down. The price of the asset went up. The price of the asset then went sideways. We confirm the change in the direction of the trend by using trend lines. Now, these are important things to remember. The steeper you draw the trend line, the less reliable it is, in the sense that it suggests that at some point in the near future, the trend will break. We could see that in the previous example. We see a steep trend line here. What happened? The price of the asset broke the trend line. We see a new trend forming. So when we draw a steep trend line, most likely the next move is for the price of the asset to break the trend line. So we see a strong decline in the price of the asset. The next move is for the price of the asset to break the trend direction. Mind you, this is very useful because if this principle holds, if there's a strong decline in the price of the asset, that means the next direction for the price of the asset to move is either up or sideways. Therefore, we can wait for a significant decline in the price of the asset. We can draw a steep downward sloping trend line, and at the end of the trend, the next direction for the price to go is an uptrend or a sideways trend. We can trade based on trend lines. We realized there was a steep decline in the price of an asset. This decline is not continuous. This decline must come to an end at some point. Then the next direction for the price of the asset to go is up or sideways. So if we bought the asset at this point here, or even bought the asset at this point here, where the asset broke the trend line, the next direction for the price of the asset to go was up. Even if the asset went sideways, even if we bought right here and the asset went sideways, this price here, these prices here are still higher than this price right here. So it will be a good trade to buy the asset when the asset breaks the trend line. Like support and resistance, trend lines become stronger the more times they are tested, meaning that when they are touched more than once, when they are touched 2, 3, 4, 5 times, this confirms the trend. And most importantly, do not ever force trend lines. In other words, do not try to overfit the trend line. Do not try to use one trend line to fit every single movement in the price of an asset, because trends change over time. So apart from trend lines, we also have trend channels. Trend channels are comprised of 2 parallel trend lines. So we see here one trend line, another trend line. These 2 trend lines appear to be parallel. This is an upward sloping trend. Likewise, we have 2 trend lines, a downward sloping trend line. These 2 trend lines form a channel. This was a downward sloping channel. This was an upward sloping channel. This was a downward sloping channel. This was a sideways channel. So now that we establish what are trend lines, and now that we establish what is support and resistance, we can learn how to trade support and we can learn how to trade resistance. Generally, when the price of the asset hits support, it bounces off support. So if support holds, the price of the asset goes, it touches support, bounces off support, and goes up. What we can do, we can buy after the bounce. We can buy after the price hits support, bounce off support, goes up. We can enter the order here. We can set a stop loss at this point here. So you may be asking, what is a stop loss? If the price of the asset moves against us, we want to minimize our loss. We want to minimize our risk. So what we do, we place a stop loss. A stop loss is a limit order. So we place a stop loss. It means that when the price of the asset moves against you, if it hits this price, the order will close. Yes, it will be a loss, but it will be a small loss. Let me show you an example. So I will place a limit order right here, a limit order to buy limit. Click modify or delete order, modify, and then I'll set my stop loss. My stop loss, I'll put my stop loss at 50. I will set my target profit, let's say at 70. Now the stop loss. The stop loss is the price. You set a price. So if the price of the asset moves against you, if the price of the asset drops to $50, the order will close. In this case, it will close at a loss, but it will close at a small loss. The target profit is where we set the price where we want the order to close. If the price of the asset moves in a favorable direction and it hits my target profit, here my target profit is $70, the order will close and it will close in profit. I will realize my profit. So this is the order right here. I place an order to buy here. This was the stop loss. Let me move the stop loss. Let me carry the stop loss higher. This would be my target profit. In fact, the better thing to do is to put the stop loss right below support. How do I know this area? This area support. How I know this area support? These are lower lows. This is a low, this is a low, this is a low. So 1, 2, 3, 3 low points. This is an area support. I will put the stop loss just below the area support. I put an order to buy right here, and this is my target profit. If this order gets filled, when the price of the asset drops to this level, the order will get filled. If the price of the asset keeps declining and hits this area, the order will close. It will close in a loss, but the loss will be a small loss. If the price of the asset hits this area here, the order gets filled. And if the price of the asset goes up and hits my target profit, I will realize my target profit. My target profit is $70 right here. So another way to trade support and resistance is to trade the breakout. Recall, the price of the asset can break support and the price of the asset can break resistance. So if we are trading the breakout, we want the price of the asset to break support. The price of the asset goes going down, it breaks support. We can enter an order here to go short. Short means to sell. We enter order right here to go short, right below support. The stop loss will be placed above support. Now, we can trade like this. However, I tend to trade with a retest in the sense that I want the asset to pull back, touch the area of support that is now acting as resistance, and then for the asset to go down. So I want the asset to price to go down, pull back, touch the support, and then go down. Let me show you an example. So we see here, this range is an area of support. So the price of the asset went down, it consolidated around support, it went up, it breaks support. Now, it breaks support, yes. I could have entered a trade right here, but I would not enter a trade right here. Why? Because there's no retest. There was no retest of this support. It was just a strong breakout, there was no retest. So I think this was somewhat of a risky trade to enter a trade right here. I would have entered the trade at this point here. Why? The price of asset breaks support, it didn't retest resistance. It went up, it break, well, this support now serves as resistance. It break this area, it consolidate. However, there's a break right here. This is the point where I'll enter the trade to sell because the price of the asset broke support, it goes up, it retests the area, which now serves as resistance, and then the price of the asset goes down. So I would have entered the trade to short to sell somewhere around here because this is the area of support. The price of the asset breaks support, it goes up, it touches support, the support now acts as resistance. So there's a retest, it goes down, it pull back, it touched the area of structure right here, there's a retest, it goes down, I'll enter the trade right here. And if I had entered the trade right here, if I had gone short, I could have ride the decline in the price of the asset all the way down. The same principle can be applied to resistance. So we see here, this is as a potential area of structure. This can serve as resistance or support. So we see the price of the asset broke resistance. It came down, it retested resistance, so there's a pullback, and then the price of the asset went up. I would have entered an order to buy at this area here. I would place my stop loss just below the support area here. So I'll place my stop loss maybe around here, and I would buy here, and I would ride the trade up. So I would have placed my stop loss somewhere around here. So in this trade, if the price of the asset went up, it came down, retest support, goes up, I would have buy the asset, I would have go long on the asset around here. I'd have placed my stop loss around here, and my target profit would have been set somewhere around here. Mind you, although I set my target profit at this area here, 0.99868, the asset price still went a bit higher than my target profit, meaning that if I had hold the asset a little longer, I could have made a larger profit. However, I would have still take this trade because it gave me a very good risk to reward ratio, in the sense that the reward was higher than or larger than the risk. The risk to reward ratio was 1.12. The size of the reward here, which is the green area, the potential win here is larger than the potential loss. So for me, this was a good trade. This gave me a good risk to reward ratio. So I would have taken this trade. So this is another way how to trade the market. Trade the retest. The price of the asset breaks resistance, pulls back, it tests the area of structure, it tests the area which is now serving as support, resistance that is now serving as support, and then the price of the asset goes up. You place an order to buy somewhere right here. You place an order to go long somewhere around here. You put the stop loss just below support. The same concept applies. The price of the asset breaks support, it pulls back, it retests the area of structure. The area that was previously support is now serving as resistance. It retests resistance, and the price of the asset goes down. I place an order to go short somewhere around here. I put the stop loss somewhere around here, just above resistance, and I ride the trade all the way down. So we previously looked at trend lines, we looked at support, we looked at resistance. However, technical analysis also includes indicators. Indicators are indices. Indicators are indices which provide information about an asset. These indicators are usually computed by some formula. Some of the popular indicators are moving averages, Bollinger Bands, moving average convergence divergence, also known as the MACD, and the relative strength index. So the most common indicator is a moving average. A moving average is a way to smooth out price fluctuations. It takes the noise out of the data. By moving average, it means that we're taking the average closing price of the asset over the last X periods. This might sound technical, right? Let me give you an example. So this is an Excel chart, and the Excel chart gives a plot of WTI prices over the period 2000 to 2021. This line graph shows the closing price of WTI oil prices. Let us compute a moving average. This is a 4-point moving average. This is an average of the last 4 points. Here we have a moving average. This is a 4-point moving average. Let me plot this diagram. So we see in this diagram, the actual price is red, the moving average is blue. We can see that the moving average is very close to the actual price, because the moving average, although the moving average is smoother than the actual price, it didn't smooth out all the fluctuations. So let us derive a longer moving average. Observe, this is a 10-point moving average. It is an average of the last 10 observations. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we compute the average of the last 10 observations and we plot the average. This is a moving average. The average moves 1, 2, 3, 4. The average moves. So we plot the average. We can see here that the moving average, which is identified by the blue line right here, the moving average is smoother than the actual price. Basically, the moving average smooths out some of the price fluctuations. So by moving average, we mean that you are taking the average closing price of the asset for the last X periods. There are different types of moving averages. Each of them have its own level of smoothness. Generally, we can change the length of the moving average. So we saw previously when we changed from a 4-point moving average to a 10-point moving average, the 10-point moving average allowed the price of the asset to be more smoother and exhibit less fluctuation than the 4-point moving average. Generally, when we make the period of the moving average longer, it smooths out more fluctuation. Let me give you an example. So this is the asset we previously examined. This is a moving average. This is a simple 9-point moving average. The blue line is the simple 9-point moving average. This moving average was computed taking the past 9 observations. Since the time period we are looking at is 1 day, this is a 9-day moving average. So it shows how the price of the asset changed on average over the past 9 days. Let us look at a longer period. This is a 50-point moving average. We made the length of the moving average longer. As we expanded the length of the moving average, it filtered out a lot of the fluctuations. As we can see here, the 8-point moving average closely followed the price of the asset. However, the 50-point moving average filtered out a lot of the fluctuations in the price of the asset. The 50-point moving average was smoother than the 8-point moving average. Apart from the lengths of the moving averages, there are 2 major types of moving averages. The first type we considered was the simple moving average. The simple moving average is calculated by adding up the last period's closing prices and dividing the number by X. So if we look at the 10-point moving average, this found the average of the last 10 observations. However, each observation is given an equal weight. In other words, the same emphasis is placed on new observations and the oldest observations. In contrast, the exponential moving average places a higher weight on the more recent observations. Simple moving averages and exponential moving averages can both show the trend, they can both show the direction of the market. However, the exponential moving average is better because it places more emphasis on more recent observations and it places less emphasis on the older observations. Nevertheless, both tend to say the same thing. So we see in this example here, the 30-point simple moving average and the 30-point exponential moving average. Both moving averages move almost in the same direction and provided the same information. However, we know that the exponential moving average is supposed to be more robust than the simple moving average, since the exponential moving average places a greater emphasis or greater weight on more recent observations than older observations. So how do you remember which moving average is faster? You can remember the example with the rabbit and the turtle. This is the rabbit or the hare. This is the turtle or the tortoise. The exponential moving average is like the rabbit. or here, the exponential moving average is faster than the simple moving average. The simple moving average is analogous to the turtle. This is just a simple analogy for you to remember. But generally, both moving averages are supposed to give you the same information. When you want to get different information from moving averages, you should change the length of the moving average. If you want a moving average to closely follow a time series or the price of an asset, you should use a shorter period moving average. For example, you should use an 8-point or a 9-point moving average. If you want a moving average to filter out a lot of the false signals, you should use a longer period moving average. For example, you can use a 50-point or you can use a 100-point moving average. Generally, the longer period of the moving average, the more fluctuations in the price of the asset it filters out. Moving averages are very useful. They can be used to indicate areas of dynamic support and dynamic resistance. Previously, when we drew trend lines are used to determine static support and static resistance, meaning that the support and resistance are drawn by a horizontal line and they stay the same. In contrast, dynamic resistance and dynamic support can change as the price of the asset change. Here we see the 50-point moving average, the 50-point exponential moving average acting as dynamic resistance. The price of the asset bounces off the dynamic resistance. It bounces off the 50-point moving average at this point here. It bounces off the 50-point moving average right here. It bounces off the 50-point moving average right here. Generally, since the price of the asset is below the 50-point moving average, this suggests the price of the asset is in a downtrend. It suggests that the asset prices are bearish. Then we see the price of the asset break the 50-point moving average right here. So we see a change in the trend. The price of the asset was in a downtrend. It was bouncing off resistance, the 50-point moving average. It was bouncing off resistance. And then at this point, there was a breakthrough. There was a crossover. The price of the asset went from below the moving average, and the price of the asset went above the moving average. So there was a crossover, this dynamic resistance, and then the price of the asset started to bounce off the dynamic support. So the dynamic resistance is now acting as dynamic support. The price of the asset is now in an uptrend, and it is bouncing off support. It is bouncing off the 50-point moving average. So the next technical indicator I want to show you is the Bollinger Band. You might be asking, what is a Bollinger Band? A Bollinger Band is a confidence interval. It is a 95% confidence interval. In other words, 95% of the fluctuation of the price of the asset will be within the Bollinger Band. However, 5% of the movement in the price of the asset will be outside the Bollinger Band. This is a very important piece of information. If we know for certain that 95% of the fluctuation in the price of the asset will be within the Bollinger Band or within the range, and 5% of the fluctuation in the price of the asset will be outside the Bollinger Band, we know that when the price of the asset goes outside the Bollinger Band, the next direction for the price of the asset to go is inside the Bollinger Band. And we see it right here. The price of the asset went outside the Bollinger Band, then the price of the asset went inside the Bollinger Band. The price of the asset went outside the Bollinger Band, then the price of the asset went back inside the Bollinger Band. These are Bollinger Bands. The green lines on the outside, the green lines are the Bollinger Bands. This line in the middle here is a 20-point moving average. The Bollinger Bands are 2 standard deviations away from the 20-point moving average. The whole idea behind the Bollinger Bands is the Bollinger Bounce. The price goes out the Bollinger Bands, but since the Bollinger Bands represent a confidence interval, the price of the asset must go back inside the Bollinger Bands. So the price goes out, it comes back in. Price goes out or touch the Bollinger Bands, it must go back in. An alternative to the Bollinger Band is the Keltner channel. The Keltner channel is used to help identify overbought and oversold conditions. I'll explain the concept of overbought and oversold when I go into the relative strength index. The middle line of the Keltner channel is an exponential moving average. So previously in a Bollinger Band, the middle line was a 20-point moving average, and it was a 20-point simple moving average. In a Keltner channel, the middle line is a exponential moving average, so it will be a 20-point exponential moving average. We know the exponential moving average places higher emphasis or higher weights upon more recent observations than older observations. The two outer lines of the Keltner channel are based on the average true range rather than the standard deviations. So in other words, they show on average the average true range, the average range in which the price of the asset was fluctuating over a period of time. This is the average range. So the range is the cap. So the range will have a highest point and will have a lowest point. So the range is the cap, the area between where the price of the asset was fluctuating over a period of time. The red lines here are the average true range. In contrast, the Bollinger Bands, the outer lines here would have been 2 standard deviations above and 2 standard deviations below the 20-point simple moving average. Generally, the Keltner channel shows the same information as the Bollinger Band. So I don't rely on the Keltner channel, I rely on the Bollinger Band because I get the information that I desire from the Bollinger Band. The next tool I want to explore is the moving average convergence divergence, also called the PIDT. The PIDT is a tool that is used to identify a trend. The PIDT shows you 3 things. One is a fast moving average. The blue line here is a fast moving average. Then you see a slow moving average. The red line here is a slow moving average. The green area here shows the distance between the fast moving average and the slow moving average. The PIDT gives you signals to buy or sell. Here we see the fast moving average crosses the slow moving average. So the green area here, which is the gap between the fast moving average and the slow moving average, this gap becomes smaller. At this point here, where the fast moving average crosses the slow moving average, this point here would be a buying signal. You can see the gap between the two, moving averages, the green area here, it becomes smaller, and the signal changes from a sell signal to a buy signal. So at this point here, the PIDT suggests that you should buy the asset. The PIDT can also provide a sell signal. So we see here, the blue line here crosses the red line. So the faster moving average crosses the slower moving average. So it goes from above to below. And the green area here, which shows the gap between the 2 moving averages, it becomes smaller and then becomes 0, and then it becomes larger. So this is a sell signal right here. So although the PIDT is used by a lot of traders for buying and selling signals, I do not rely on the PIDT simply because I can get the same information from examining multiple moving averages in a moving average crossover. I will explain a moving average crossover in detail in a future lecture. The next indicator I want to explore is the relative strength index. The relative strength index, or the RSI, is used to evaluate if the price of an asset has reached overbought or oversold conditions. You may be asking, what is overbought and what is oversold? Overbought usually refers to when the price of the asset has become too high. So when the RSI value has become over the number 70, it suggests that the asset is overbought. When the RSI value becomes lower than the number 30, it suggests the asset has become oversold. When assets are overbought, it suggests the price of the asset are too high and the next direction for the price of the asset to go is down. Likewise, when assets become oversold, it suggests the price of the asset has become too low, and the next direction for the price of the asset to go is up. So this is our relative strength index here. We see the price of the asset went up, and then reach here, it reached overbought conditions. When it reached overbought conditions, the next direction for the price of the asset to go was down, and the price of the asset actually went down. As the asset went from overbought conditions and went back down to normal areas, the price of the asset went down. Let me give you an example. So in this example here, we have the RSI. We can see the asset became oversold at this point here. This level here was 30. This level here was number 70. At this area here, the price of the asset became oversold. So this gave us a buy signal. We can see here, it suggests to buy at this point here. If we bought the asset at this point, the next direction for the price of the asset to go was up. And we saw the price of the asset go up. Let's see if we can identify an overbought condition. We can see here around the 17th of April, the price of the asset went into overbought conditions. The price of the asset went into overbought conditions. At this point here, the price of the asset went from overbought to normal conditions. So this gave us a sell signal. So if we sold the asset at this point here, on this date, the 30th of April, 2019, that's the USD CHF. If we sold the USD CHF on the 30th of April, 2019, this would have been a winning trade. The price of the asset went all the way down. So if we had gone short, the price of the asset would have gone all the way down. So you can see the RSI is a very good indicator because it gave us a direction. It told us in advance the direction the price of the asset may go. Look at another example right here. The price of the asset went into oversold conditions. It suggests the price of the asset became too low. If we bought the asset at this point right here, the 10th of March, 2020, if we bought right here, the next direction for the price of the asset to go was up. Observe the RSI suggests the asset was oversold. It suggests to buy right here. Observe at this point here, a price cost crossover occurred. So this also suggests that we should buy the asset. I will explain a price crossover in greater detail when we go into trading strategies, my video about trading strategies, but just observe or note that a price crossover also occurred at this point here. So this also gave us a buying signal. Observe the RSI went into overbought conditions. The RSI went above the number 70. It gave us a sell signal right here. So we sell right here. So this is a potential good trade right here. So if we take this trade, the asset went into overbought conditions. The RSI went into overbought conditions. We enter a trade at this point here, the 9th of March, 2021. We enter a trade, we go short right here. We set the stop loss about here, just above an area that was potential resistance. So resistance is about here. We set the stop loss just above resistance. We go short. Going short means to sell. We set the target profit around here, and we wait to see what happens. We see the assets went up. The price of the asset went up. It went closer to the stop loss, but didn't touch the stop loss. And then the price of the asset went down. This trade looks like it will be a winning trade. So this brings me to the end of this lecture. In the next lecture, we will explore technical analysis in greater detail. Thank you and stay tuned for more.